Okay, so on the face of it, the Kenyan market had a fantastic week. I mean, the headline numbers, they look great. But, if you scratch just below the surface, you'll find a much more complicated story, one with some pretty serious warning signs hiding in plain sight. So let's dive right in.
All right, first up, let's talk about that big headline number. The total market cap at the Nairobi Securities Exchange, it hit an incredible 2.8 trillion shillings. Now, that's the kind of figure that just screams investor confidence and a healthy market. A really, really solid result for the week.
And get this, it wasn't just a narrow rally, not at all. The gains were spread across the board. You've got the all-share index, the NASI, up 3.7%. The NSE 20, the one that tracks all the big blue-chip companies, that was up 2.5%. And the NSE 25, up 3.1%. I mean, literally all the key indicators were flashing green. It really painted a picture of widespread optimism.
But you and I both know that market indices are just the average, right? The real drama, the juicy stories, that all happens down at the company level. So let's zoom in and look at the two stocks that really define the extremes of this week's trading.
And what a tale of two companies we have here. It really captures the week perfectly. On one hand, you've got Crown Paint, which just soared, up over 15% thanks to some absolutely stellar earnings. And then on the other hand, you have Umeme, the electricity distributor, which dropped over 8.5% because its main business concession in Uganda just expired. I mean, you couldn't have two more different stories driving the market.
So you're probably asking, what was behind Crown Paint's incredible run? Well, this number, it really says it all. A jaw-dropping 480% surge in net profit for just the first half of 2025. That's just wild. And it was all driven by strong sales and really tight cost control, which, as you can see, rewarded investors and sent that stock price absolutely sky high.
Now, for Umeme, the story is the complete opposite. It's a total nightmare, really. This week's almost 9% drop, that's just the latest chapter in what has been a disastrous period for them. With that Ugandan concession gone, the company is staring down a massive revenue collapse. The long-term damage has been nothing short of catastrophic. I mean, the stock has bled out over 70% of its value in just a couple of months.
Okay, so now let's pull back from the individual stocks for a second, because this is where things get really interesting. There's a fascinating contradiction here. While the stock market was basically throwing a party, another, much quieter market was telling a very, very different and much more cautious story.
You can really see the split personality of the market this week right here. On one side, you had stock investors, who were clearly optimistic, buying up shares. But on the other side, bond investors were getting nervous. The bond index actually fell by over 2%. And here's the key thing to remember. When bond prices fall, their yields, think of it as the interest they pay out, go up. And that's a classic sign of caution. It means bond investors are demanding to be paid more to take on risk.
So, to really get what's happening here, we need to quickly understand how the government borrows money. It all starts with something called a competitive bid. This is pretty much when a big investor, like a bank, goes to the government and says, hey, this is the exact interest rate I demand if you want me to buy your bonds.
And the flip side of that is a non-competitive bid. This usually comes from smaller investors. It's basically them saying, look, I'll take whatever the final interest rate ends up being at the auction. Just keep those two ideas in your head, because they are the key to understanding what happened next.
Okay, now look at this. This is so telling. When the government tried to borrow money, investors basically said no thanks to the short-term options. The 91-day and 182-day bills, massively undersubscribed. But they absolutely flooded into the 364-day bill. So why the difference? Simple. It offers a higher yield. This is a huge signal that investors are worried, and they want to lock in better returns for a longer period of time.
Of course, we know that Kenya doesn't exist in a bubble. So let's zoom out and take a look at the global picture, because there are even more interesting things happening with currencies, commodities, and yes, crypto.
So the shilling held its own against the US dollar, which is always great news for stability, but the really noteworthy part is how much it strengthened against the British pound and the euro. I mean, the shilling gained over 2% on the pound and 1.4% on the euro. That tells you a little something about the perceived weakness in those European economies right now.
Meanwhile, commodities had an absolutely huge week. Silver, oil, gold, they all posted some really strong gains. This is classic behavior, right? When there's global uncertainty in the air, investors tend to run to physical, safe haven assets. And the oil rally also got an extra kick from some supply disruptions, which just adds another layer to the story.
But in a complete 180, the digital world of crypto saw an absolute bloodbath. Just look at these drops. Solana, down almost 14%.
Ethereum down nearly 10%, and even the king, Bitcoin, fell over 5%. What a stark contrast to the rally we just saw in physical commodities. It really just hammers home the insane volatility in the crypto space.
So, what on earth caused that crypto crash? Well, it was mostly a technical thing. It's what they call a leverage flushout. Basically, way too many traders had borrowed a ton of money to make super risky bets, so when prices dipped just a little bit, it set off a domino effect of forced selling. It ended up liquidating almost $1.7 billion in futures and just completely washed all those speculators out of the market.
So, after a week that was just full of conflicting signals, the big question is, what's next? Well, let's turn to the economic calendar and see what could shake things up in the coming days.
All right, there are two key events you're going to want to watch. First up, on Tuesday, we have the interest rate decision coming out of Australia's central bank. That's going to give us some big clues about where global monetary policy is headed. Then, on Wednesday, we get the big inflation numbers from the Eurozone. If inflation comes in hot, it could really force the European Central Bank's hand, and that would send ripples through currency markets everywhere.
And so all of this leaves us with one big overarching question. We've got this tale of two markets, don't we? You've got the sheer optimism of stocks and commodities on one side, and then you have the caution from the bond market and the absolute chaos in crypto on the other. So, which story is going to define what happens next? The bull or the bear? That is the question that's going to shape the market in the weeks ahead.